Hey, what's up, my friend? So in today's episode, right, you'll learn all about riding massive trends, right, that others can only dream of. So I remembered, right, back in my prop trading days. So I was, buying dollar yen. There was this particular trading setup. I call it the false break. So price basically broke out, and I believe it was on either the 1 or 2 hour time frame. There was a false break setup at support. So I bought it, right, just part of my trading setup, and I went long, and I went home. The next day, I remembered, right? Dollar yen, it just exploded up higher, right? And I was thinking, hey, what's going on, man? Because I saw usually when you're trading, right, one of the first few things that you log on to see is your P&L. My P&L just shot up, right, in the green massively. And I was wondering, what happened? Then I realized BOJ intervened the market, right? And that led, right, dollar yen to exploded up higher. And I happened to be right there at that point in time, right? Just nice, right, to catch that huge wave. And if you ask me, right, you can say that in a way I was lucky because I have no idea that BOJ is going to intervene at that point in time. I have no idea, right, that trading setup that I took, right, that looked like just like any other trading setup, that would be the one, right, to let me ride a massive trend in the market. And I believe, right, that particular trade, I achieved about a 1 to 45 or 1 to 50 risk to reward, right? Meaning if you risk $1, you get back $50 in return. So that was a very big winner for me. And today, right, I want to share with you a few lessons, right, about trend following. And if you want to adopt this method, right, this method of trend following, then these few things that I'm about to share with you is important. Number one, if you want to ride massive trends in the market, you cannot have a target profit. I know this sounds, logical, but some traders just don't get it. For example, if, I bought dollar yen, and if I'm happy with, let's say, a 50 pip target, there's no way that I'm going to ride the trend. Because when you have a target profit, in essence, what you're doing is saying to the market, oh, okay, this is enough, man. Don't give me any more profits. Let me just book my profits and get out of the trade. Now, that's not wrong, right? If you're coming from a swing trading perspective, that's fine. But if you are trying to ride a trend in the market, you cannot have a target profit because you are limiting your profit by having a target profit. So, as a trend follower, if you want to ride massive trends in the market, the only way to do so is to have a trailing stop loss. So what I mean by trailing stop loss is that as the market moves progressively in your favor, you will trail your stop loss, right, to kind of, lock in profits along the way. So let's say the market goes from $100 to $120. Your trailing stop loss could be, let's say, $110, for example. Okay, you're giving it a $10 buffer, wiggle room, right, to move, right? If it hits 110, then you exit the trade. Does it make sense? So that's a trailing stop loss. Number three, if you want to ride massive trends in the market, you got to expose yourself to many different markets. Because here's the thing, right? You just have no idea at which point in time which markets are going to trend. Okay? So if you really want to increase your odds of capturing a trend, riding a trend, you want to expose yourself to different markets. Trade Forex, trade bonds, trade agriculture, commodities, equities, trade all these different markets from these different sectors. And that would really increase the odds of you capturing a trend. Because just imagine this, let's say you only trade euro dollar, pound dollar, Aussie Canadian, euro Aussie, and a few currency pairs. Compared to a trader who trades 50 different markets, let me ask you, who has a better chance of riding a trend? Clearly it's the one who trades more market, right? So that's the thing, right? You have to trade a variety of markets. Don't limit yourself to just a handful of markets because, that really is not putting the odds in your favor. Number four, right? Since you know that you have to trade a lot of markets, then this is where your risk management comes into play because you have no idea which market is going to trend. Often the market breaks out, it's a false breakout, and it goes back into a range. And that's why you must risk, right, a small fraction of your trading capital on each trade. If you ask me, right, anything more than 1% is too much. 1% and below, right, that's a good a benchmark to consider whenever you put on a trade and hoping those trade, becomes a monster winner. Take, for example, right, Richard Dennis, he's he's the head for Turtle Traders, and if I'm not wrong, he actually went into a serious drawdown with a trend following methodology. And if you ask me, it's because he was risking about 2% risk on each trade, and I find that that's way too aggressive. So if you're gonna ride trends in the market, you got to bring down, right, your risk per trade level because you have just no idea, right, when you capture a trend. Even if you might be trading 40 or 50 markets, you still have no idea, right, when the trend will come. So that's the fourth thing, right? You must risk a fraction of your trading capital. And finally, right, the fifth thing that I want to share with you is something that I've discovered recently, right, based on the sharings of Andrea Unger. So he says that different markets, right, have different behavior, and he shared a very simple backtest to figure that out, right? So what he did is that whenever the price breaks above the previous day high, you go long. And you hold that long position, right, until the price breaks below the previous day low. And then you go short, right? And you keep doing this, so this backtest over and over again with how much data you have. And what you realize is that if a market has trending behavior, the equity curve will slope up over time. And if a market has a mean reverting behavior, meaning whenever it breaks out of the previous day high and then goes back into a range, it will have a negative equity curve. So I run it across different markets, forex, futures, and I realized that yes, different markets have different trending behavior based on the time frame that you're trading as well. And what I realized is that markets like pound dollar, pound yen, gold, these are trending markets, meaning that they have a tendency to trend better than markets like, let's say, Aussie Canadian, or maybe markets like bond markets. Okay, so this is what I found. So that's another thing to consider, right? If you want to ride trends in the market, okay, you can also consider, right, focusing on markets, right, that have a tendency to exhibit a trending behavior. So that's pretty much it, right, for today's episode. Hope you got some value out of it. With that said, if you enjoyed it, hit the thumbs up button, subscribe to my YouTube channel. The link is below. Click subscribe, and I will talk to you soon.